Welcome to the 3-Edge Week in Review for the week of April 21st. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3-Edge Asset Management. Today, Steve and I will discuss the market's reaction to the Trump administration's sweeping tariff policies, and we'll seek to understand what signals the markets may have been sending in response to the Trump administration's announcement of tariffs on April 2nd. And this is important for investors to understand, since what we may be facing is really an existential shift in the current system of global trade. And this has all caused a great deal of market volatility. Immediately following the president's announcement, stocks, longer maturity U.S. Treasuries, and the U.S. dollar all declined rather dramatically, while the price of gold surged higher. Then this past week, U.S. equity markets have recovered some of those losses. However, they're still down year to date as investors struggle to position portfolios during this uncertain time. So without further ado, let me bring Steve into the conversation here. And so, Steve, as we know, when President Trump announced the plans for imposing tariffs on U.S. trading partners, the response from the markets was pretty quick and not necessarily encouraging for investors. Now, this past week, we have seen equity markets claw back some of those losses. So my first question for you is, what signals, if any, are the stock, the bond, and the foreign exchange markets trying to send about the Trump administration's tariff policies?
Well, it's often said that the biggest bully on the world scene is not any individual, it's not any country, but it's the global capital markets. And history has shown this to be true over and over. And I would agree with you, Fritz, that over the last several days, this has been incredibly confirmed that the first reaction to the tariff plan was the U.S. stock market falling precipitously. And from its peak, when tariff plans were more unveiled, to its bottom, the U.S. stock market fell almost 20% just in a few weeks. But it wasn't just the U.S. stock market. Maybe even more troubling was the bond market. And as yields climbed, meaning the bond prices fell, that caused even more consternation and perhaps even more backtracking on this tariff plan. And the reason why that's true is that while the stock market affects the global economy and many investors to a great degree, the bond market has an even bigger effect, because as the bond market goes, interest rates go, and when interest rates climb, it hurts all people at all levels, not just people who own stocks. And so it's even more pervasive. And then the icing on the cake was the U.S. dollar. Usually, when it looks like a country is going to improve their trade situation, it helps the currency of that country, because it means that more dollars are coming into the country and not going out. But in this case, the U.S. dollar fell sharply over a few-week period. And that was a sign that investors all around the world are rejecting the tariff plan, or they're saying, no, this doesn't make any sense. And with all the chaos and the changes, is the U.S. dollar or U.S. dollar-based assets reliable? And so the U.S. dollar sold off strongly. And another sign of the U.S. dollar selling off was not just against other currencies, but against gold. And we saw gold hit an all-time high of $3,500, which many people a year ago would have been shocked if someone had that as a projection. So these are all strong signals. And then, as you also mentioned, when the U.S. started to back off and delay tariffs and decide to make some exceptions, and now just recently China's starting to make some exceptions with its tariff plans, all of a sudden that's brought at least a temporary rebound in the market. So the markets rule, and the markets are reacting very strongly to this tariff idea.
All right, excellent. So clearly far too early to say what the ultimate outcome of the tariff policies will mean for the economy and the market. And as you mentioned, by far the most important negotiations will be between the U.S. and China, the world's two largest economies. But I think it could be helpful if perhaps you could lay out a few potential positive scenario that might play out, and then what might be a negative scenario that we could encounter in the months ahead?
So I just want to set some context about tariffs. Tariff is just a fancy term for tax. And it's not a tax on a rival country. It's a tax on yourself. It's a tax on your own companies that import products. And so history has shown that countries that introduce tariffs are hurting themselves more than they're hurting other countries. And if I were a political cartoonist, which I'm not, I can't draw at all, but if I was able to, I would have a political cartoon where Uncle Sam would be screaming at the rest of the world saying, if you don't do what I want, I'm going to shoot myself in the leg. And then the rest of the world saying, well, then we're going to retaliate and shoot ourselves in the leg. I mean, it's that silly. And I don't mean to make so much light of it, but it really is that silly when you understand what a tariff really is and in history what's happened. So the positive scenario is that everyone backs off on the tariffs. And we go back to the world we had before, which was back in the stock market bubble, where an overvalued market gets even more overvalued, but people, continue to buy stocks. The bond market settles down, the dollar settles down, and we're back off to the races until there's another catalyst to bring this overvalued market back to normal. And so we might see a more lengthy rebound. We might see even new highs. There will be a limit to the upside because of the nature of the overvalued market, but investors have shown that they're emotional beings and they act in crowds, and the crowds can become greedy again, and we can see overvalued markets getting even more overvalued again. So that is a possibility. There's been so much bearishness that sometimes you get a counter reaction that lasts quite a bit. So best case scenario, everyone backs off from the tariffs, finds face-saving ways to say, oh, okay, you gave me a concession, I'll take the tariffs off. And companies in other countries do the same. Worst case scenario is that egos are involved, and that the most important trading partner that we need to reconcile with is China. And the U.S. is saying that negotiations are underway and everything's going to be fine. China is saying there are no negotiations. That's fake news. And we won't negotiate until the U.S. unilaterally removes all the tariffs before we even start talking. And so that's going to be a typical game theory situation. And if the egos get in the way, it's lose-lose for everybody. And so that's a downside scenario, that we don't really remove all the tariffs. And remember, even though there's some optimism that, well, maybe the tariffs will get back down to the 10% number that we mentioned, a 10% tariff was all it took in 1971 to cause the global economy to go into a decade of stagflation. So even a 10% tariff is not so great. So maybe the downside scenario is we have some hope that we're going to back away from these tariffs, but we actually don't implement that because we're waiting for other countries to make concessions and they don't. And then we have a recession. It's not out of the question that we'll find out a few months from now that the recession started all the way back in April or May, and it gets backdated like it typically does. And the markets aren't priced for a recession, so we could have another leg down.
I have a quick follow-up to that. What about the Fed? So, what is their role here? Or they seem like they're kind of stuck here. They're not in a good spot. So how might that affect things?
So at the last official announcement from the Fed, they indicated that their biggest worry is that they have to, their dual mandate is to fight inflation and keep employment going. And if tariffs are enacted, it's going to cause inflation to go higher, which means they have to raise rates, but it's also going to kill the economic growth, which means they have to lower rates. So they're going to be between a rock and a hard place, as we've often said in the past, if these tariffs continue. And my guess is that they will, at any sign the economy is weakening, they will be tempted to want to lower rates to keep the economy from going into a risk recession. But typically, by the time the Fed does that, it's too late and you're already in recession. The other side is that if inflation starts to pick up in the real data very soon, that's going to keep the Fed from perhaps not being able to cut like they have in the past. And the whole idea of the Fed put that was true when we had a low inflation environment between 1980 and 2020 might be a thing of the past. So we will see.
Yeah, a bit of a wild card. All right. So, as always, my final question. We've seen the Trump announcement of the tariff policies. We saw the market sell off. We've got a bit of a rally here this week. So, just a lot of uncertainty and very volatile markets. So, how might investors think about positioning their portfolios in this, quite volatile, highly uncertain environment?
Because the near term is so dependent on policies that can change on a dime by different participants, we recommend not to be tempted to be overconfident and bet all the way on one extreme scenario. We think it would be a mistake to put all your money back in equities now because it wouldn't take much for the stock market to fall again. On the other hand, the upside scenario is not impossible, and we wouldn't recommend being completely out of equities either. So we're sticking with our idea that if there's ever time to be diversified, it's now, because the gap between the positive scenario and the negative scenario is so wide that we think it's just better off to not play either extreme. So have some equities, but keep it cautious. Be closer to your minimum than your maximum range of equity allocation. Don't be all in one country, but be a bit diversified across the world. We've seen for the first time in years that non-U.S. equities are actually outperforming U.S. equities, and that might continue because of the valuation difference. Have some hedges against the potential of stagflation. That threat hasn't gone completely away yet. So have some gold, perhaps not as high as your maximum allows, because we might have seen the high-end gold for a while a few days ago when it hit 3,500, but I wouldn't be completely out of gold either. And on bonds, I'd be careful and stay away from the duration risk on the long end and stay at the safer short end of the bond market.
Excellent. Thank you. And thank you for the update on the tariff situations. Obviously, very, very important. And it's really the topic that everyone is talking about these days and all investors are concerned about. And we will continue to keep our clients and listeners informed as trade negotiations continue to play out in what is clearly a very fluid situation, to say the least. So that will do it for Steve and me for this week. As a reminder, all our videos are always available on our 3Edge YouTube channel. If you know someone you think might benefit from these videos, please feel free to share them. If you are a regular watcher, we would very much appreciate if you wouldn't mind subscribing to our 3Edge YouTube channel. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.